I'm going to teach you how to plan your mortgage amortization and how to shrink your mortgage, basically how to pay it faster and finish it off. And with that, I'll also show you how to save a lot of money. Mortgage amortization. Now, you might say, what's that? What does that even mean? Amortization. First of all, mortgage itself, it's rooted into the word mortuary. And basically what it means is you pay until you are in the mortuary. You pay till you die. So we want to reverse that. We want to kill the mortgage. And amortization is basically killing the mortgage off before it kills you. So what is our plan? First thing you do, you have to shop around. And don't be shy about asking around for advice and asking different banks, different brokers to just get the best deal. First thing first, get a good deal that suits you. So you have to consider your own budget, your own expenditure monthly, spending, income, and all those things that you have around you, your circumstances, and the worldwide economy really has to be all taken into consideration. So you have to see what suits you, but also you have to always consider how to pay it off faster. Look into the details of the deal. When they offer you a deal, you have to look into the details, not just the interest rate, which is what most people look at. What I'm going to share with you here is the product of years of experience and doing things wrong many times, many years, and learning from my own mistakes. So looking at the interest rate only is not the best thing. It's not the only exhaustive thing that you have to look at. Interest rate is important, but interest rate itself is not the final thing to make a decision on that, which is what mortgage dealers, banks, and lenders will emphasize on to draw your attention. I'll explain that in more details when we get further. So one of the things that you need to consider is mortgage period itself. So you go to a bank and they say, okay, we have these deals, and how long is your mortgage for? And so you say, for instance, it's 15 years, or 20 years, or 25 years, whatever it is. That is the length of that's the period of the mortgage. By then, hopefully, if things stay the same, which never will, if you keep your payment up to date and you pay as it is with the interest that you have right now, carry on for that length of time. After 15 years, 20 years, 25 years, 10 years, 5 years, whatever it is, you finish the mortgage payment and you pay it off. So that is the mortgage period which we are talking about, not the deal itself. Because when you go and make a deal with a bank or broker, they give you a deal which is for, let's say, 1 year or 2 years or maximum 5 years. I don't know, they might offer you even longer than that. But however, the mortgage period goes beyond that. But your mortgage deal ends, let's say, in 2 years, or you haven't paid off your mortgage. So it's not like after 2 years you pay off your mortgage, unless your mortgage is very small and the amount of money that you pay monthly is large, or one or the other, or both of them. However, mortgage period goes usually beyond the mortgage deal, and that is why you keep having to change your lender or keep renewing your mortgage with the same lender. It doesn't matter whether it's the same lender or another new lender, you have to renew it every 2, 3, or 5 years. So the length of the mortgage is important. You have to look at that, because you could just look at that and looking at your circumstances, you can say, okay, I can't afford at the moment, let's say £500 a month. But what I can do, I can increase the length of the mortgage from 15 years to 20 years. So £500 a month or $500 a month, depending on which country you're in, can be reduced to £300 a month, let's say. So you're not really saving as such, but you're paying it less often, so the bankers won't chase after you. You can make the payments, you can keep up with the payments. So that's just the way basically you're looking at your circumstances. You just say, okay, I can't afford more than £300 a month, and I know my situation is not going to get any better in near future. So at the moment, I can only afford this much. And when you do that, don't stretch yourself. You have to leave some room for emergencies, for things like that. Breakdown, your car breaking down, your house breaking down, I don't know, something happening in your house. So you have to have some sort of contingency plan for that one. So if you're reducing or increasing the length of the period, you have to consider your budget or your circumstances, your economical circumstances, whether you can afford it or not. I've done it in the past. I've actually gone the other way. I can't say wrong or right. I've done it the other way. I've actually asked the bank to reduce the mortgage period. Let's say if it was 20 years to begin with, after 2 years, I've asked them to reduce it to 15 years. So I've jumped, basically, I've skipped years, thinking that would actually help me. It does help you in a way. You're paying it off faster, but it also stretches your payment, your finances. So every month you'll have to pay a bigger amount of money every month. Instead of, let's say, if you were to say you were paying £350 a month for that 15 years period, now you've reduced it down to 10 years, then you'll have to probably pay £500 a month or a lot more. However, it's more, and you have to consider whether you can afford that commitment, because it's a commitment. And your mortgage deal, you can't just go, if it's for 2 years, for instance, halfway through the even second year, first year or second year, and say, I want to cancel it, I want to move on to a different broker or a different lender, then they'll charge you a penalty. In most cases, they charge you a penalty for early repayment, which is another thing you have to consider. So mortgage deal is important. Now, mortgage deal itself comes under categorically 3 different types. They're either variable or fixed rate or interest only. Now, when you consider the definition of them, or when you look into what they actually mean, then you might think, okay, fixed rate might be a good idea for you, again, for your circumstances, or variable might be good, or interest only might be good. However, variable means the interest rate, if it's, for instance, 1.9% to begin with at the start of your mortgage, or at the start of the deal, if it's 1.9%, it can change at any time. So tomorrow it might be 1.7%, or it could be 2.1%. So it doesn't normally change that much. It changes probably 0.1 or 2% every jump they make. But you have to consider, again, the global economy, what's happening in the world, for instance, things like big things that might, change the economy of at least your nation or your country or your worldwide economy. For instance, the coronavirus, or Brexit or new American president coming, things like that, that can change. Or the recession, for instance, we had recession around 2009-10, and I knew, for instance, when I had to renew my mortgage, I knew the interest rate is not going to go up, at least for a while, at least for a couple of years. So what I did when I changed that, I changed it to variable. What I usually was almost always went for fixed rate. That means your interest, when they make a deal or a contract with you, then your interest rate stays as that for that period until your deal is over. For instance, for that 2 years or 5 years, the mortgage deal that you have, the 2% or 5% or 3% or whatever percent interest rate that is to begin with, it'll stay that way until it ends. And then after that, it might go up or it goes down, and it usually goes onto variable automatically. It goes onto variable from fixed rate. It goes onto variable rate, which in England usually tracks the Bank of England. In other countries, tracks something else. It's variable, so they can change it at any time. And they'll tell you at the beginning what that is at that time, what that variable rate is at that moment. But again, at the end of that 2 years period, it might change. But fixed rate, that interest, if you have it on fixed rate, it is staying that much for that 2 years period, for that length of period that you have made a deal for. Interest only is only basically within that period of that mortgage deal that you have. Within that time, you only pay the interest, so nothing from your capital comes down. So if you start with a starting balance of, for instance, $100,000 or £100,000 mortgage, then at the end of the 2 years or 3 years or 5 years, whatever your mortgage deal is, that stays the same. So you haven't paid a penny of that. All you've paid is basically for the bank's interest, and for the bankers not to chase after you, basically, to keep your house, basically. It's like a rent, basically. You're paying and it's gone out the window. Once it's gone, and you haven't paid for any, you haven't paid anything towards the capital. So now we know the definitions of them. Now we know which one's which one means what, and what they do. However, again, like I said, you have to consider your personal circumstances and global or national circumstances, what's happening. Like I said, during the recession, the last recession, the worldwide recession we had, I decided to go on variable because I knew that the rate is not going to go up anytime soon. When I did that in 2010, so I went on variable, and things went, in my favor, because I was only paying what the interest rate was at the time, and it was always going down. So when the interest rate was going down, I was actually tipping the balance up. I was paying more to top it up. Basically, I was topping it up. So when the interest rate nationally was going down, and my lender was reducing the interest rate, then I was topping it up, actually, and my payment was being topped up. So at that time, when I was on variable, and the interest rate was, for instance, going down, because it was following the Bank of England and it was going down, then I was actually topping it up sometimes to pay towards the capital to pay the mortgage off earlier, which was good and beneficial. And then at one point also, when I changed again during that time, I didn't have a job, and I didn't have any reliable source of income, so I wasn't sure if I could afford relying on variable rate and basically risk the rates going up and not being able to pay and basically lose my house. And also fixed rate would be also another commitment that, let's say, if you're paying, for instance, monthly, again, £350 a month, probably £100 of that was just the interest. So to make that kind of commitment that I would have to pay every month £350 at that time when there was recession worldwide and you don't know when it ends and when it bounces back up again, the economy, and whether you can have a job soon or later, you don't know. Nothing is clear. So what I did, I went on interest rate only. When you do interest rate only, then what you pay is only the interest. So, but the advantage of that is that, for instance, for my case, if I was paying only £100 a month, that was interest. That was basically my rent, basically sitting there, keeping my house. So what I did, if I could afford, anytime I could afford, I could top it up to £200, £300, as if I did have that fixed rate, because I knew how much I would have to pay if I did have the fixed rate. So you're basically managing it, but you're not obliged to do that. So if you don't pay 1 month and you only pay the interest, as long as you pay that £100 a month, for instance, for my case, I would have to pay that £100. As long as I'm paid that much, then nobody's chasing after me. But if I made more than that, then I'm going basically back to, if I made that regularly, it would be basically the same as paying the fixed rate, and you're paying towards the capital and you're bringing the mortgage down. So that is why you have to look at your circumstances and your situation. Otherwise, it would be always, everybody would go for the same thing, because you can't say this one is best for everyone. However, certain things are common, and it might sound like common sense after a while, or once it's explained to you, but nobody explains these things to you in details like I'm trying to do here. And even mortgage advisors, they charge a lot of money and they give you a deal that is really in their own interest, not yours. And also, the other thing you have to look at is the flexibility of overpayments. Some lenders don't allow you to make overpayments, or they limit it. For instance, they say in a year you can only pay £5,000 or whatever dollar or US dollar or whatever the currency is. In our case, usually has been the deals I've had has been probably around about £7,000 a year. You can overpay your mortgage. But you have to make sure you have that flexibility. Sometimes you don't have that. And when you do make overpayments, when you do come up with some money and you want to make some overpayment towards the capital, then they might actually penalize you. So you end up worse off than not overpaying. Another thing that you need to look at is withdrawal or early repayment penalties. For instance, if you wanted to cancel your mortgage, let's say you even want to sell your house and pay it off, you have to pay your mortgage off when you sell it, and that is classed as early repayment, and they can penalize you and charge you a certain amount of money. So you have to look at that. Are you likely to sell your house within a couple of years or 5 years? Then you decide. If, let's for instance say you don't want to sell it in 2 years time, but you might sell it in 5 years time, then you better not go for a 5-year deal. You better go for a 2-year deal, or even shorter, if you don't know what you're going to do. But if you know, for instance, you're going to stay there for the time being, for a long time, then you can rest assured that 5 year, for instance, is good enough for me. But again, withdrawal, if you, for instance, found a better deal somewhere else, somebody else approached you, another bank, another lender approached and said, look, we can give you this mortgage. You're on, let's say, 2.9%, we can give you 1.7%. And we pay the fees as well. Well, you have to look at the fees and penalties to see if it's worth it or not. I'll get into more details of these further on. And also, another thing you need to look at is mortgage holidays options. Do you even have that option in your plan, in your deal? Some lenders give you the option of sometimes, after, let's say, certain length of time you've been with them, they give you the option of, let's say, 1 or 2 months or 3 months maximum, probably, holidays. What that means is, it doesn't mean you don't pay and your mortgage keeps going down. Your mortgage stays frozen. It stays the same. You just don't pay for, let's say, 2 months or 3 months rent, basically. You don't pay for that. But when you start paying, you'll still have to pay that balance. So it's not really beneficial for you to do it if you can afford it. If you can afford it, never ever take the option of taking holidays, mortgage holidays. Don't take that. But if you can afford it, if you can't, then you stop. We have coronavirus. Some people are affected by it. We have other businesses, people losing their jobs. Then, take the option. Take that option if it's available to you. But when you start the deal, you don't know what's going to happen tomorrow or the next year or within that period that you have that deal for. If this deal is for 2 years or 3 years, you don't know what's going to happen in 2 or 3 years' time. Especially with how the whole world is volatile, things can change at a drop of a hat. So you better have that option at least available to you. Then, don't use it. But if push comes to shove, at least you can use it. You can have that. Next thing I need to talk about is the keeping up with your payments. That is very important because obviously if you don't pay, they can chase after you, they can take you to court. It's a lengthy process, it's a hassle, and you don't want to even get into that at all or anywhere near it. So first of all, make sure you can actually pay regular automatic overpayments to your lender. So you need to contact your lender, or at the beginning of the deal that you made the deal with them, you have to ask them whether you can make overpayments. If you can make the overpayments, can you actually set up a direct debit, something like that, to pay automatically? So it will go. You have to make sure it will go towards the capital. Now, in England, most of the talk that I've done so far has been based around Britain and the rules and laws in this country. However, most of the things that I've said so far are common principles and they're applicable in other countries as well. But the way you apply them might be different from one country to another. For instance, here, I just pick up the phone and say I want to make this much overpayment, and they know this will go towards the capital. However, I stress that this wants to go towards the capital. In other countries, probably America, as far as I know, I think you have to actually write to them. You have to write to them and say, I want this amount of money going towards the capital, not just the interest. So otherwise, most banks would prefer to take that money and just pay towards because some of the lenders, the way they've set up the mortgage is such that the mortgage deal is front-loaded, if you like. Front-loaded, that means most of the chunk of the money that you pay goes towards the interest for quite a few years before it even starts paying towards your capital. The deal I have personally here is a repayment deal. What that means is whatever you pay, a percentage of it goes towards the capital and a percentage goes towards the interest. So my balance every month goes down a little bit. But lots of lenders, whether you're in Britain or other countries in America, particularly, they are front loaded, and you need to be aware of that at the beginning of your deal. And if you haven't made yourself aware of that, or you don't know about it, you need to contact them and ask them whether it is front loaded or not, whether you can make overpayments and pay that towards the capital, towards the balance, so it brings it down. So if you say, for instance, your capital right now is 60,100, and if you pay that 100 right now, you want to make sure that balance goes down to 60,000. So exactly that 100 goes towards the balance, nothing less, nothing more. Make sure you set up a direct debit to make regular overpayments towards the capital. Right. Again, this is another commitment you make to yourself, really, because it's an overpayment. You can stop it at any time. Nobody's going to ask you why you do that. But when you want to make that overpayment, that commitment, again, look at your circumstances and see what you're doing, whether you can do it or not. And then contact them, like I said, and say, I want to do this. Get the direct debit details. Set up a standing order rather than direct debit. Sorry, this should have been a standing order rather than a direct debit. That's my mistake. The difference between a direct debit and standing order is direct debit is set up usually by the sellers, let's say banks, mortgage lenders. You haven't got that much control over it. You can only go and cancel it, and they will know immediately you've cancelled it. And if you've cancelled it within their terms, then they'll come after you. But a standing order is when you pay. You set it up. They don't set it up. You set it up, and you pay them, and you can stop at any time. And it's all within your control. So I should have mentioned here, set up a standing order. That's my mistake. However, you just make overpayments and regular overpayments, so you won't forget. Basically, 1 month you might pay, next month you might not, and it won't really. It's still beneficial every time you make an overpayment. It's still beneficial to you, but you're not seeing the results that effectively. And also, you need to have a look at your mortgage deal and see if your mortgage is split. Sometimes the lenders or yourself, when you borrowed the money to begin with, you needed an extra money. You either went and remortgaged the house and got an extra money, or you actually at the beginning they couldn't give you all in one loan, and they split it into two kind of loan, and they split it, usually with the same interest rate, but sometimes it varies. Sometimes, for instance, loan number 1 has one rate and loan number 2 has a different rate. So you need to have a look, see if you've got one borrowing money from them, one lot or 2 lots of borrowing. If, let's say, for instance, your borrowing amount of money altogether is 150,000, is that 150,000 in one lot, one loan, or 2 loans? One of them might be 60,000 and the other one might be 90,000. So 90,000 and 60,000 forming that 150,000 altogether. You have to look at that. The reason for that is if you want to pay towards the capital and the interest of one of them is different to the other, you want to pay towards the one that has a higher interest rate. You want to pay towards that one, because the sooner you pay that one, the less you pay interest. Next one is make sure your annual overpayment doesn't exceed the limit. Like I said previously, your bank or your lender might have a limit, might have allocated a limit amount of overpayment that you can pay within a year. And I made an example, for instance, in my case, is £7,000 a year that you can only overpay. More than that, you can't pay more than that. If you do pay more than that, you will be penalized. They'll charge you a fee. And when it comes to that, really considering the fees and all that, it's not much. It's not really worth it, unless you're making a big lump sum to just maybe clear one loan or both, all the loan altogether. Then yes, it is worth it. It depends again how much is left and how much time is left on it and all that. Now, if you have other savings, let's say you have an ISA saving account or children's saving account, and it's a good habit to have savings for your children, as they grow up. It's fine. But if you have a big mortgage, or your mortgage is not even big, but it's a burden, then it's unwise to put the money that you put aside for your children to grow and use it someday in the future. It's unwise to do that when you can put that money towards your mortgage, towards the capital, and bring the balance down, because your children's savings account or ISA saving account doesn't pay you that much interest. I can assure you they won't pay you as much interest as your mortgage lender charges you interest rate. So the best option would be, in most cases, at least I can say, if not 100% of the cases, in most cases, take your money. If you're putting aside any money for anything, I would still advise you still keep some saving for yourself. Don't put all your eggs in one basket, because once you give the overpayment, make any overpayment to any lender, that's gone. It brings the balance down for sure, but you can't go back and say, can I have that money that I overpaid last month back? They won't give you that back. So you still need some emergency savings account or emergency money put aside somewhere. But having said that, if you think you're saving with your ISA savings account and you're making money with that interest, you're fooling yourself, because you save more money by paying less interest on your mortgage, which is paying towards the mortgage. So you just have to keep the balance. I'm not saying put all your eggs in one basket, no, but just keep a level head up. Making overpayments of any amount to the mortgage lenders is always preferred and should be your priority, rather than saving your money in an account, in a savers account, whether it's an ISA account or anything else that you're saving for a long-term plan, basically, or a long period of time to harvest anything from it. It's always wiser and beneficial to you to pay towards the mortgage rather than saving it somewhere that you think they're paying you interest, and because they won't pay you as much interest as your mortgage lender is charging you. The last thing is paying your mortgage off. Now, one of the things, when you have the money or your mortgage is gone down to the amount that you can actually pay it off, one of the things you need to check is your bank or lender doesn't charge extra fees for your overpayments or early repayment. Let's say you've got another 1 month left on your mortgage, and now you have that amount of money that's left on the balance that you can pay. You have to see if that month is worth paying it right now to get rid of it, or keep it another month going till the deal is over, so they don't charge you for that 1 month of they don't charge you, so they don't charge you extra fees for early repayment. 1 month of 1 or 2 months, or even 6 months, maybe even a year of payment, monthly payments, as you've been doing for years, interest probably isn't as much as the fees that they will charge you for early repayment. So you might be better off putting the complete payment of the mortgage till the deal is over. So you run out of the mortgage deal and go on to variable, or just the same day that is the end of the deal, or the same day that's the end of the deal, you just go and contact them and say, I want to transfer this amount of money. And then you won't be incurring any fees. However, if you're selling your property to pay the mortgage, for instance, make sure the money your buyer pays into your account, either directly or through a broker, solicitor, or lawyer. You don't get charged for fast payments. Opt out of it if possible, because banks charge a certain amount of money in England. Certain banks, the bank that I was dealing with, I sold the property, and when I was getting the money, they said you have to pay £35 or something like that to transfer this amount of money the same day or the next day into your bank account. And I just called them and said, look, I'm not in a rush. I don't want that money right now. You can send me in a week time. And so just a week time, if you're not in a rush, you're saving that amount of money. That was about £35 for sending this, and £35 about something else adds up. So why do you pay the banks any amount of money extra because you're getting your own, money from the sale of your house, your property? Why should you pay extra? So look into those details. They might not be much, but still saves you, and it's still money in your pocket than in the pocket of the big guys. Don't pay your lender the whole amount in one go, as you will most probably be charged by the bank that transfers the money into their account. Talk to your bank and find out the maximum limit without incurring any charges, so you can make your payments to the lender in a few lots rather than one lump sum. So, for instance, I sold the property and I wanted to pay towards the mortgage of my other property, and it was a big amount of money. To transfer that, the banks would charge me fees, and like I said, whether I paid it today or next week, it wouldn't change my interest that much on the property that I'm already paying the mortgage. It won't change a big deal. So a few days wouldn't make big, massive difference on my interest. But what it would make is I'm paying an extra fee to the banks to transfer, let's say, £100,000 from one bank to another. So what I did, I split the money, and I just basically transferred 30,000, 50,000, 60,000, at the time, whatever the maximum limit was for that bank. You have to ask that bank, or the recipient bank and the sender, see how much they send and how much they can receive. So you send that amount in lots of, let's say 50,000, 60,000 or 20,000, and just basically finish it off that way. And that way you don't incur any charges. Otherwise, you'll have to pay for any amount over than that, that limited amount. Anything more than that, you have to pay a penalty. It's not a penalty, it's a charge, it's a fee they charge. So for instance, any amount more than 60,000, they would say you have to pay a certain amount of money. And I wasn't willing to pay that. It's not being stingy, it's being level-headed and using your brain when they can make money out of you for nothing, doing absolutely nothing. Why should they? And why can't you just keep your own money instead of throwing it away? For what reason? For getting that money into the mortgage or towards the mortgage a few days sooner, which makes basically no difference. And lastly, when you do that, you need to ask for a receipt and a confirmation of the final payment. Normally, in England, they don't even give you the deed anymore. All you have is basically a confirmation letter to say that your final payment is gone, received, and this is it. This is the final, statement. They don't give you, if you buy a house, they don't give you a deed, and if you sell the house, they don't give you anything. So this is how it is, because everything is on the registrar. So in the registrar office, everything is all recorded, and you can even find that out online, who any house belongs to. When we were talking about the mortgage deal and mortgage period and the rates and how much you pay towards the mortgage and all that, I want to make reference to some examples. For example, now, this is my mortgage amortization spreadsheet, and I have here, for instance, loan principal amount. So this is the principal amount. That's the starting balance, for instance, when you go to a bank and say, this is how much I want to borrow. And that's the interest rate. The loan period in years, for instance, 19 years or whatever, and the starting year, let's say 2020, let's say June. Right, this gives me automatically the figures that I need to look at. You can't do this with just a simple calculator. You can do certain things with the calculator, but you can't find out how much you would have to pay, how much of that interest that you pay goes towards the interest, how much of it goes towards the principal or the capital, and those kind of things. And in a few years, to how many years you need to, at the end of each year, how much you've paid off, how much is the ending balance at the end of each year. It just shows you all those things. This is called mortgage amortization spreadsheet. Now, just to make an example of that, for instance, in 2018, around about August, September, I had to renew my mortgage, and my starting balance at the time was this much. So I had to basically get a loan of this amount to renew my mortgage, which was £58,925.40. Now they gave me two options, either a deal with no fees but the interest rate of 2.69%, or a deal with £995 fee at 1.9% interest rate, and this was a fixed interest rate for 2 years, which is coming up to an end soon, and I have to renew that again. But I'll tell you what I did then, so you learn from my mistakes as well. So with these two options, which one would you choose? Either no fees at 2.69% for 2 years fixed rate, or £995 at 1.9% interest rate, again fixed rate for 2 years. You can't decide with a calculator. With a simple calculator, it doesn't give you much. So you need something like that. And no mortgage advisor will tell you any of these unless you know about them and specifically ask them. And even then, they'll say, we're just telling you what their figures are. We can't give you an advice. Especially banks, they don't give you any advice. You have to get your own mortgage advisor, which will charge you. Again, will not be beneficial for you to go down that road, because if you do that, you're paying about £1,000 or something to just mortgage advisor and broker, and all in all adds up and makes basically your mortgage to go up instead of going down. So at the beginning of my remortgaging, last 2 years ago in 2018, let's say my mortgage was 58,000. Let's just go by this, 58,925 pound 40 pence, and 58,925 40 pence, and the interest rate we said either 2.69 or 1.9. We go with this one first, 2.69, and let's say the mortgage loan period in years is 19 years, and that was 2018. I'll just put down January here for the sake of argument, because we want to see exactly what happens at the end of the year, at the end of 2 years, in 2019. End of 2019. So because it just gives you a little bit of, halfway through. If I put down June, the figures won't make much difference in the figures. If I say, let's say June here, what will happen, you see 2019 starts from here, and you can't see exactly the end of calendar year for the second year, 2019. So what I'm going to do, I'm just going to put down here Jan, and from 2018 to 2020. So end of 2019, sorry, 2019, not 20. That's another year extra. So with that in mind, £58,925 40 pence, starting with 2.69% interest. At the end of the first year, the mortgage balance is £56,516 and 38 pence. So we put that there. And then at the end of the second year, let's see how much that is. So this is the end of 2018. And 2019 end of the year, the balance is £54,042.63. So we put that there. This is for your information, really. This is not from, I don't use this. It's just for you to understand what I'm doing. And the other deal says £995, but at 1.9%. So we have to recalculate everything. But bear in mind, our balance is not 58,925 40 pence anymore, because if you add this 995 on top of that, then we have to change this balance to 59,920 and 40 pence. And the interest rate is now 1.9% instead of 2.69. And we'll see the results. At the end of the first year is 57,276 and 33 pence. And at the end of the second year, 2019, is 54,581.71. Then, now we want to find out the difference between the two and make a decision. Basically, are we better off going with this, paying £995 and this interest, or paying nothing and paying higher interest? If you calculate, if you take these away from each other, subtract this from that, obviously this second one is higher. That the ending balance for first year and second year is higher than the first year and second year of this deal. So that just tells me at the end of the year, at the end of the second year, at the end of the deal, even the first year, you're better off with this first deal, because you have saved £759. Your balance is less, £759 less than this one. You've paid £995, but your ending balance is 57,276, whereas in this one 56,516. So your balance is lower here, although you're paying a higher interest, but your balance is less in the end, and the second year is further down. So still this balance is less than this one by £539. So you're better off using this one with no fees, pay no fees, and pay higher interest. So this is where everybody goes wrong. Even I made a mistake and I went with this one. Even at the time I had this amortization sheet, but for some reason I made a mistake and I went with that one. Anyway, my loss is your gain. Now you're learning from my mistakes. And paying £995, which sounds like you're getting a good deal because you're paying for it, and on top of that you're getting again better deal than this because your interest rate is lower than that, obviously. So most people would just go by that and choose that one. Whereas when you calculate it, and no banks will tell you this, no banks will tell you which one is beneficial for you. And this is not always the case. So don't go by this and think any deal that gives you a fee or asks you for a fee and lower interest, that means that's worse than the other one. Not necessarily. You just have to calculate it. So this is not a blanket sheet over, it's not a formula. The formula is really this one. You have to use this. This is on a spreadsheet. You can just have your own and calculate it. Look at your circumstances, really. You can possibly ask the bank to tell you what's the balance at the end of the year. So you get basically this information. You can get that and then calculate these and find out for yourself. Rather than, if you don't have the software, you can do it that way. You can just say, this is my balance at the moment. If I pay this much and this interest, how much is my balance at the end of the second year or first year or third year or fifth year, if it is 5-year period, whatever period it is, that deal, and how much will it be on this one. Then you compare it, just subtract it basically, and see how much better off you would be with any of those. That is how you make a decision. But like I said, it depends on many factors. This is one of the deciding factors for me. It's a factor that I go by, but there are lots of other things that are mentioned in my presentation, like your circumstances, your economical situation, the world economy, the national economy, all those kind of things that's going on. You have to consider your job, you have to consider all sorts of things. But this is the final and most important deciding factor for me, and I would presume it would be the same for most people. Alright, so now in this video, basically you should have learned how to shop around and what to look at when you're shopping around for your best deal, and how to withdraw or make early payments, avoiding any penalties. That's included in the deal. how to make overpayments without incurring any fees, and how to basically pay your mortgage faster. And you also learn how to avoid any potholes, and also you learned how to pay or receive money without incurring any extra fees that banks normally charge. Right, I hope you enjoyed this video, and thank you very much for watching this video. If there are any questions or suggestions, please don't hesitate to contact us or leave a comment there. Thank you very much. Bye.